Yeah, I think that takes us right to error number 5, auto enrollment.
I wonder how that happened.
I learned on a recent audit that auto enrollment is not always that automatic. In my case, the plan document stated that unless an eligible employee affirmatively elects otherwise, his compensation will be reduced by 5%. What I learned is that unless you actually set up those interfaces between your record keeper and your payroll HR provider properly, there is some manual intervention needed. In fact, auto increases, similar to auto enrollment, while calculated by the record keeper, in my case, were not handled correctly either in this situation, as the payroll department never received the record keeper updates. So Bill, how do we deal with this, and of course, how do we prevent it?
Okay, Eric. Before I really talk about the fix here, I think it might be best to first address what happens when a plan improperly fails, irrespective of auto enrollment. If a plan sponsor fails to enroll an employee or fails to process their deferral election properly, that's called a missed deferral opportunity. That means the employee missed the opportunity to receive the tax benefits associated with deferring money, either the tax deduction or the Roth contribution treatment that applies to the deferral. The general correction for a missed deferral opportunity is for the employer to make a corrective contribution equal to 50% of that missed deferral opportunity. So it's just a kind of a rough justice approach by the IRS to say this person has lost some tax benefits, and this would replace that missed benefit, this contribution. And then you also have to make 100% of any missed matching contribution in order to make the participant whole. And both amounts are adjusted for earnings. Now, the IRS and really the Department of Treasury really have a policy in place where they think that automatic enrollment is a very important feature for retirement plans. And they want to encourage it at all costs. But through the significant number of VCP filings that relate to auto enrollment, they knew that the internal control problem was there and that employers were not finding these errors in a very quick fashion. It was really, well after the end of the year, during the plan audit process or during the plan non-discrimination testing process that the error comes up. So they granted some significant relief to plans with auto enrollment failures. And under new guidance, there is no missed deferral opportunity if the failures are found and corrected by the first payroll date following the earlier of 9.5 months after the end of the plan year in which the failure occurred, or if the participant brings it to the plan's attention by the end of the following month. So that's very generous. The 9.5 months, that's the extended due date for the Form 5500. So they were recognizing that plan sponsors were not catching these errors. It was the outside professionals either doing the plan audit or doing the plan non-discrimination testing that would find the error. So that's a significant improvement in the timing for corrections and significant cost savings to employers. On the second follow-up slide, I do mention that there's a few requirements to avail yourself of that, reduced expense, and that's that you have to notify the participant. Now, if you go past the 9.5 months, the IRS was still being very generous in that it's only at 25% as opposed to 50% missed deferral opportunity cost. And you don't really hit the 50% until you get out 2 years in the after the error. So again, really a very, very favorable change in the rules that plan sponsors can take advantage of. And the IRS clearly has done this to facilitate and encourage plans adopting auto enrollment and auto escalation.